the key driver of the markets is going to continue to be interest rates, particularly in the U.S. They're setting the pace. The view here and the key challenge is not only interest rates in absolute terms, but also relative to inflation. And in absolute terms, I think we will continue to see the Fed to hike aggressively. The higher equity markets stay, and with financial conditions being quite loose, the more likely they hike even more. And so, in some ways, this market rallies that we're seeing now, that a lot of people are scratching their heads, how is it possible that equities are doing this? There's a lot of pain on short sellers, on people that have been hedging. I personally think it's a good time for people to put on hedges, to be conservative. This rally is tricky. So I think the first thing is to watch is what's going to happen to interest rates in a market where equities are high. They will push as high as possible, and as they do that, eventually equities come off. Yes or yes or yes. I don't see how. There's a scenario where inflation just collapses to levels of 2 to 3%. That I think it's unlikely. So my base scenario is central banks will hike, and those hikes will be notable, but it will not be enough to offset inflation. So we'll continue to live in a negative real interest rate world, with inflation continue to be high, and the risks are on both ways. So from there, I think the other things key to watch is currencies and volatility. Volatility is particularly important, and I'm going to tie this up with portfolio construction. Okay, I use the analogy very often that when you build a portfolio, ultimately it's like a team. I'm European, so I use soccer. You could use different sports; they're all very similar. But generally, it's not just about scoring goals. It's also about defending and goalkeeping. And in that sense, we've lived through a period where it looked like you didn't need any defenders or goalkeepers. You could just stay happy with your portfolio of 11 strikers, and if anything went wrong, mommy and daddy would come in, the referee would whistle offside, and that was it, right? I think we're in a situation where the match is going to be much more volatile. It's going to be much more two-way, and I don't have a crystal ball. I don't believe in portfolios with 11 strikers. I don't believe in portfolios with 11 goalkeepers, and I don't believe the coach should be taking those kind of decisions. My view is much more, okay, guys, let's build a team that is truly balanced, okay, truly diversified, okay. And by this, what I'm emphasizing is the mistake, the risk of false diversification. Okay, many investors might say, look, I have a bunch of stuff in my portfolio. I'm diversified. Okay, say you have a crypto, right? You have 20 cryptocurrencies. That's not really diversified. Okay, you have a bunch of stuff, but everything goes up and down the same way. So ultimately, what we're looking for is in this paradigm is going to be more volatile for all the uncertainty that we have. There's a lot of risk embedded. Things are going to happen, and I think the key thing is that investors build portfolios that are truly diversified. You cannot and should not be fighting volatility. You need to embrace volatility. You need to basically be in a position where if the market rallies, great, I have strikers. If the market sells off, I have goalkeepers, and you actively rebalance. It's not about having a crystal ball. It's about having that team that effectively can take the ball, pass the ball, score, defend, attack. That is the key thing, in my opinion. And when you try to build the portfolios, there's plenty of strikers. In fact, most of the investment strategies out there on the long-only side tend to be risk on plays. So I think my advice to people listening to us is this paradigm shift of arguably higher volatility, more risk is going to give opportunities on both sides. And we have to find positions where the portfolios are balanced, are truly diversified, and also I think we need to be very careful with position sizing. And I stress this a lot, but I think position sizing, there's the ultimate thermometer is your emotional distress, right? If you're trading and you are overly happy when you make money and you're overly sad, you're definitely trading too big. You want to be in a situation where you need to be careful with the leverage. Leverage is going to kill you in this environment, right? So we need to be careful with leverage, look for true diversification, and have position sizing that gives you a much more indifference in terms of what happens. The market's rallying, thank you very much. The market's selling off, thank you very much. And you are taking advantage of this by selling high, buying cheap, selling high through rebalancing. And this is the one thing that I'm basically emphasizing to investors. You need to take that long-term approach and embrace this volatility. Be careful with leverage and seek true diversification, because ultimately, let's not fool ourselves. Whilst volatility has been extraordinarily low, even in the last move down, the VIX sub 30 has been a bit of a surprise for many people given the sell-off we had. I think we're going to see a much more volatile period with those spikes, and at that point, it's not just about volatility, it's about liquidity, it's about correlations. Yeah, it's how the team behaves. And so it's I'm trying to give this cautious outlook that we're here for the long term and we need to build these portfolios thinking as a coach and the entire team. When people look at their portfolio with 11 stocks and they're all in green and they're very happy, that's a source of concern, because if they're all green, they could well be all red. So it's much better to find that true diversification, and that's what I recommend from an investment perspective. Having said that, there's going to be tactical opportunities and things that you can play. And from my perspective, as you know, our focus is much more on the defensive global macro, and I think there's a lot of value in the volatility space from these levels. There are assets like gold that I think are very well positioned for the medium long term. There are things like the dollar that I think continue to offer good value as a hedge, particularly against currencies such as China, where you have this divergence. There are pockets of tail risk and extraordinarily cheap insurance against different pockets, things like Hong Kong or even long-dated volatility or duration, which is also a great defender. So it's about building that team, that defense in a diversified manner, and to do that, it's an art, but it takes a lot of science as well. So our focus tends to be much more through the options market, through insurance. But again, I think each investor will need to build their own team. You're the coach. You decide how you want to play, and whether you manage yourself, your money, or you outsource some of it. I think just be prudent and look for the things I just discussed.
If you enjoyed this video clip, click here to watch another one you should like.